Hello. So the company being analyzed today is Gulf Oil Lubricants India. This company is engaged in the manufacturing of industrial and automotive lubricants, lubricant that fuel. Lubricant that liquid. The company is also the second largest in India's private sector lubricant market. Only one ahead of this company, only one ahead, I believe, is Castrol India, the clear leader in this market. But Gulf oil is second and it's growing faster than castor oil. Okay. So today our aim is to analyze the company's financials, analyze the company as in what it does, its future growth prospects, its capacity expansion, its cash flows, and at the very end, there's some very exciting stuff about the company. So let's start. First, the market cap. So the market cap is 6,124 crores. So it's not exactly a small cap company. Price of one share is 1,242 rupees. Book value per share. Book value, assets minus liabilities. Book value per share, 297 rupees. We move a little to the right. Dividend yield is 3.86%. So dividends paid for fiscal year 2025 were 3.86% of 1,242, which is around 48 rupees, 48 rupees, somewhere around that dividend. Then the return on equity, below me, return on equity, 25.5%. That's a really, really nice return on equity. Return on capital employed, again below me, 28.3%. Extremely nice return on capital employed number. The stock PE or the price to earnings ratio of 16.5. Okay, so very nice return on equity and return on capital employed. Now we have the profit and loss of the company from 2015 all the way to 2025. Okay. Okay. Yeah. So in 2015, we have sales of 967 crore rupees. All these numbers are in crores. Operating profit 129 crores. And below it, you see OPM, 13% operating profit margin. Let's move on. 2019, 1700 crores of sales. Then slump during COVID. 2022, 2100 crores of sales. 2023, massive 2999 crores of sales. And finally, fiscal year 2025, 3554 crores of sales, 470 crores of profit. Okay. Then the profit before tax actually increases because it receives some other income from non-operating activities, and this other income turned out to be larger than depreciation and interest expense for this year. So 486 crores of profit before tax, finally giving us 362 crores of profit after tax. Okay, so let's look at these numbers from this perspective, percentage perspective. So compounded sales growth for last 10 years has been 14%. Last 5 years has been 17%. Last 3 years, 17%. TTM refers to trailing 12 months, the previous 12 months, 9%. So almost double digit sales growth. Very, really nice sales growth for the last 10 years. 14% is pretty solid. Compounded profit growth last 10 years has been 16%. 5 years, 12%, 3 years, 19%, and trailing 12 months, 13%. So, solid profit as well as sales growth shown by the company. Then, return on equity, yes. 10 years ago, 27%, 5 years ago, 24%, 23%. Sorry, 3 years ago, 24%, last year, 25%. Stable. The least we can say is it's stable. Now, let's go to the cash flows. Now, this is interesting. I don't know if you can see it. Okay, yeah, cash flows. These are the cash flows of the company. Let's pay only the attention to cash from operating activities. So in 2015, it's 131 crores. 2017, 134 crores. Okay. Then 2020, 237 crores after this massive dip. Then 273 crores, 2023. Then stability, last 3 years. 423 crores in 2025, 348 in 2024. So I think we can see pretty volatile cash flows, but if you want, you can lump them in three. You can lump 3 years of cash flows in one. So 19 crores, 131 crores, 118 crores, 134, 110, and 17. So these years, if you lump them together and see how much was produced cash flow, not a lot of growth. Here, I think 237, 194, and minus 24 does mean higher. If you lump them together, it does produce higher cash flows than before years. And then this 3 year streak, of course, is the massive one. So it's very, very fluctuating cash flows, very volatile cash flows, especially in the past. But we take them in lumps. We do see there is a certain amount of growth going on, which is good in cash flows. So good revenue growth, good profit growth, stable return on equity, and growing growing cash flows. A bit volatile, could be a bit volatile, but in the past few years have shown a level of stability and a level of size. Like 423 crores for its market cap of 6,200 crores. Pretty nice. Now let's see what the company actually does. Okay. All right. All right. All right. Fine. So main business will always be selling oil lubricants. Okay. Now see this. Above me, the growth exceeding three times the industry rate. This company has outgrown the overall industry by a huge margin, by quite a margin, and is increasing its market share because it's outgrowing faster. So it's increasing its market share, three times industry growth. Then, to my right, Gulf Oil Lubricants records highest ever quarterly volume, revenue, and EBITDA for quarter one fiscal year 2026. Then its consolidated quarterly revenue crosses 1,000 crores for the first time. Okay, then their subsidiary. They have a subsidiary doing EV charging, electric vehicle chargings. Tyrex is a name, and its revenue for the quarter grew by 163%. And finally, and finally, the board has approved capital expenditures for 55 crores to enhance manufacturing capacity by 70%. They're going to increase the manufacturing capacity of lubricant oil by 70% to 240 million liters. Okay, so massive capacity expansion. Fine, let's continue. Let's continue. Yes. All right. Now here are the two facilities. We have one at Chennai, one at Silvassa, and there's a planned capex of 55 crores for expansion of production facilities, aiming to boost the company's installed capacity by 70%. And the company's broader strategic growth objective is to grow 2 to 3 times volume growth. All right, here you can see capacity, current, and planned capacity. Chennai one is being doubled 70%. So maybe this should lead to some massive revenue growth. Realistically speaking, it could because of this massive expansion after this expansion is complete. Then, so the market it is in, it's in the Indian lubricant industry. The current demand as of 2023 in millions of tons was 2.6 million tons and expected to be 3.6 million tons by one estimation. Okay, in 2033. Then here you can see volume growth next to me comes out to be 3 to 4%. But along with value growth, meaning more valuable products, more profitable products, the growth overall for the industry will be 6 to 8% when considering value. Okay. Here it sees it's one of the fastest growing key markets among the USA, Europe, and APAC region. Okay. 3 to 4% growth in the industrial oil lubricants and 2 to 3% in the automotive oil lubricants. Okay, so they are divided into two things, industrial automotive lubricants. Fine, fine, fine. Yes, let's move on. Yes, company overview. Finally, some good things. All right, retained our strong position. Let me zoom in. So here we are seeing how the industry has grown, okay? And here let's see how they have grown. So from 2016 to 2019, the industry grew by 2 to 3% annualized, but Gulf oil grew by 15%. So six times was the growth rate. 2019 to 2022, COVID-19, a demonetization, all that, the auto sector slowing down. Growth was -5 to -7%. Gulf oil still managed to grow by a positive 1.2%, again outgrowing the industry. Then 2025, 3 to 4% the industry's growth, and 9% was Gulf oil's growth. So Gulf oil is still 2 to 3 times outgrowing the industry, and it still wants to, its objective is to outgrow the industry by 2 to 3%. Sorry, 2 to 3 times industry growth. Now, among the private sector of India, it is the second largest company in this market in terms of volume, distribution, pricing. All right. I think OEM leading, it's the leading company for supplying lubricants to automotive. All right. And these are two other segments, AdBlue and battery. These are two other business segments. But even this, in these two other business segments, you can see it has got a very strong position. Number two in the AdBlue market, and number four in the EV, electric vehicles battery market. And second largest brand, the largest being, of course, I think Castrol Oil India. Then, mm, 16 years of growth, 2009 to 2025, 9% annualized growth in volume from 2009 to 2025, 14% growth in revenue, 17% growth in EBITDA, 23% growth in profit before tax. So consistent growth for a long, long time, even in volume, even in volume. Moving on, business model. 93% of the company's revenues come from domestic market and 7% coming from exports. Okay, here we have B2B and B2C channel. So B2B, business to business, industrial, okay, infrastructure, mining, port, OEMs, marine sector, all right. Then to B2C, we have distributors, we have retailers, mechanic workshops. So I think the thing we can learn from here is that again, export revenue is there, it's international revenue, so it's markets, broader scope, because again, it can sell to more and more markets. It has shown it already sells. Then a large number of industries it caters to. They've got infrastructure, even mining, automotives, mechanic workshops. All right. So that's pretty good. And what is this? Industry product mix, the Gulf oil product mix. Let's look at Gulf oil product mix. What we have? We have, what is this? 38% plus 22% plus 25%. Hold up, how have they categorized this? Pretty, hmm. DEO is diesel engine oil. Okay, 38% of their products are used for diesel engine oil. Okay, 25% are used for industrial. Okay, 15% are used for other purposes. All right, 22% is used for personal mobility. So this is the mix. Their products are used in which industry for which uses. All right, all right. Let's continue. Let's continue now. Yes, Pan India network. Pan India network. Yeah, on too big. Yeah, Pan India network for the different enterprises. So first is the B2C network. Here they have 90,000 touch points. Touch point in business is basically point where consumer can interact with your service or product. So there are 90,000 places in India where you can meet or see a product. You can interact with a Gulf Oil's product, buy a product, something like that. 320 auto distributors. Here they're saying growing at 10 to 15%. So they're growing their distribution network, which is important. And across 522 cities, they have their Gulf bike shops and car stops. Ooh, they have their own stops selling their own lubricants for cars and all. Okay. B2B, B2B, 70 industrial distributors, 500 direct B2B customers, 3,500 secondary customers. Okay, so the businesses, who do they sell to? Those customers. So I believe that's the secondary customers, 880 IMF customers. I have no idea what that means. Then battery sales and service network. Now, this battery refers to electric vehicles battery, but they don't actually manufacture it. So main thing is they have such a big distribution, right? Like 2,500 retail touch points, 220 distributors. They Gulf Oil, of course, has its own distributors, its own sales team. So it's utilizing its distribution and its sales team in order to just resell these products. So it buys batteries from manufacturers and it resells them, utilizing its current distribution network for maximizing profits. Okay. And Gulf battery service points are there 518 and 13 dedicated service engineers. All right, all right. Moving on. We have the next segment, AdBlue. AdBlue. Now, what is this market? What is the AdBlue market? Now, AdBlue is a urea-based solution. Now, urea is a nitrogen-rich compound formed by metabolism in mammals' bodies. So it's a nitrogen-rich compound formed by metabolism in mammals' bodies, and I guess it's changed. Of course, it's chemically enhanced or something is done to this urea, and it can be used as a product. And that product is AdBlue. Now, what AdBlue does is very interesting. AdBlue is an urea-based eco-friendly product for diesel vehicles. It reduces NOx emissions. So these harmful NOx emissions coming from diesel vehicles. In order to reduce them, urea-based, this AdBlue is used. This AdBlue is used. Okay. So here you've seen a multifold growth in volume. Now, is this for the industry? Is this for that Gulf oil themselves? I'm not sure. But here we can see there has been a massive growth in kiloliters. You can see for AdBlue, this product, and and Gulf oil holds a 20 to 25% market share in this market. See, market is positioned for high double-digit growth and emerged, like Gulf Oil has emerged as a leading supplier of AdBlue across the market country. It's a front runner in catering to OEMs and aftermarket to superior distribution network, 20-25% market share in this place. Um, and what else? I think it's the second largest. We saw that. It was the second largest in this AdBlue market. Okay. But main revenue still comes from, as we already discussed, Gulf Oil, sorry, the lubricant business. Yes. Then batteries. It's the top five players in the replacement two-wheeler segment. Replacement two-wheeler segment. It commands a 2 to 3% market share in replacement market. I'm actually not sure what exactly is a replacement market. To leverage our lubricants retail distribution, this business was established so they can make even more money. And what else? Appointed Indian cricketer Hardik Pandya as a brand ambassador. 2,500 to 12,500 retail touch points, 220 distributors, okay, and investing in brand, leveraging lubricants, retail distribution strategy. All right, all right, all right. And finally, we have some subsidiaries, some other business, e-mobility or the electric vehicles value chain. It's engaged in this new industry, EVs, one in the form of EV fluids, okay, EV fluids, launched globally as well as in India in 2021, formulated specifically for hybrid and fully electric vehicles for optimal performance in order to reduce CO2 emissions. And basket consists of transmission lubricants, coolants, greases, brake fluids. So again, as EVs are also cars, they will need lubricants. So EVs growing market, and yeah, I guess Gulf Oil shows or it's planning that it can grow with this market. Then again, I think they have a lot of access and strong relationship with two-wheeler and passenger car original equipment manufacturers in India, strong brand image. These are all the things, the key strengths that will keep them ahead of competition. Then, yes, strategic initiatives to participate in the end-to-end EV value chain. So they are strategic investments they have made. One, they have a 7.5% stake in Indra Renewable Technologies. They make slow home AC chargers for electric vehicles. So they make chargers. Then they have 26% stake in Tech Perspect Software Limited. What does this do? This is a software provider, software as service provider. It provides, let's read. It provides service providing to leading OEMs, OMCs, CPOs, and charger OEMs. Okay, a service. Hmm. It provides software to these original equipment manufacturers, I guess. Okay, SaaS provider, and Tyrex Transmissions. Big 103 crores investment, 51% stake. Tyrex Transmission. They mentioned this. They're making DC direct current fast chargers for electric vehicles. Okay. They currently have over 3,000 high capacity EV fast chargers, already 3,000 deployed across India. Okay. They're catering to PSUs, charge point operators, and automotive OEMs and retails. Okay. And this quarter, you already saw 163% growth in revenue. Small base, but still okay. And what are the potentials for these markets? Okay, so this first one has a strong presence in the UK home EV charger segment. Ooh, superior technology chargers to be launched globally, including India. So global product, global potential. All right. Exclusive rights to use Indra's technology for EV charging and products in India. Wow. So I guess they will be using this tech and they can maybe even resell this tech. Maybe not using their distribution network, maybe they can even resell it, but not sure. But they do have a stake, which means I guess if revenue, the company makes revenue, it can be reported. A portion of the revenue can be reported as Gulf Oil's own revenue in consolidated statements. Okay, what about this SaaS provider? It is the second largest CMS provider in India with over 15,000 chargers in the app. Already second. Okay. It already has 50,000 downloads of electrified charging app. Okay. Already second largest. I guess I have no idea what this means. Okay. Now the big one, Tyrex. Tyrex. It has signed an MOU, a memorandum of understanding, kind of like a early stages of a contract with the government of Gujarat for a large electric vehicle direct current charging MFG plant. It is estimated to have a 8 to 10% market share in India for DC fast chargers and is keen for export opportunities. And India's EV charger segment is expected to have a demand surge. The potential market could be $1 to $4 billion. Is that only this DC charger market, which it already has a 8 to 10% market share? Ooh, okay, so big potential, especially for this DC fast chargers. And finally, the exciting thing I want to show now, ownership and stakeholder value creation. 24.2% annualized growth, increase in dividends, okay, and 423 crores cash flow is generated. The dividend per share, you can see how it has increased from 2015, sorry, 2025, massive increase, 24%, 23% annualized growth in dividends is insane. They also bought back 85 crores of their own stock. So if they're buying their own stock, which means it pushes up their earnings per share because the denominator, the total number of shares, goes down. So they're actually even buying back their own shares. And finally, the most goated thing I may have ever seen. Okay. First of all, the total quantum. Okay, total dividends paid in last 5 years are 642 crores and a buyback of 85 crores in fiscal 2022. Then the dividend payout ratio was 65% and 57%, 65%, 57%. And finally, I hearted this, they have mentioned an annual maintenance capex requirement for the business, 25 to 30 crores. The only business I've ever seen actually mentioned directly in the report an annual maintenance capex requirement. Now, what is maintenance capex? It is the capital expenditure required by a company to maintain its assets, not expand, only to maintain. And it's crucial. This figure is crucial for calculating the free cash flow of a company. Okay. And to conduct a discounted cash flow model for company to value a company. So 25 to 30 crores, they've actually mentioned it. Only company I've seen actually mentioned the annual maintenance cash flow. So great, 25, 30 crores, 6,500 crore company. Okay. And their business levers are gradually expanding margins, improving product mix, superior cash flows, and better working capital management. Working capital are the funds a company needs to fund the day-to-day operations. Now, we looked at the business. It has a very strong position. It's growing very well. It's actually bought back shares, which is good. Mentioned annual maintenance capex requirement, which is great. Finally, finally, it's time to see the annual report. Only two things from here. One is revenue from operations. All right. These numbers are in lakhs. Numbers are in lakhs. So revenue from operations, you can see finished goods, lubricant oil. So they made 3,300 crores or 3 lakh 30,000 and 14 uh, lakh. So 3 lakh 30,000 and 14 lakh rupees or 3,300 crores from lubricant oils. And then you can see traded goods. We have batteries, 80 crores, 80 crores. You can see last year, what the hell? Okay. Batteries and greases. Greases for I think cars, even in cycles and all, grease, you apply that. What is that? 241 crores. These are traded products. What do you mean traded products? They have just bought it from someone else and they are reselling it to their own distribution network. They're utilizing their distribution network. So majority revenue still, in fact, comes from lubricants. Then we have greases and others and all that. And finally, let's take a look at the balance sheet of the company. This is the annual report. So where is the balance sheet? Yes, consolidated balance sheet. Very interesting balance sheet actually. Again, the numbers are all in sorry, are in lakhs rupees. Now, it's coming very small. How do I? Okay, I hope you can see it. You can see property, plant, and equipment. It's around 24,166 crore, 66 lakhs, coming around to 241 crores. Remember, property, plant, equipment, 241 crores. This company's cash and cash equivalents, this company's cash and cash equivalents are 1,000 crores. So for 240 crores of their property, plant, equipment, this company has 1,000 crores in cash and cash equivalents. Last year, how much it had last year? Last year, this company had 7,000 crores. Am I reading this correct? Am I reading this correct? Hold up. Sorry, yes, 703 crores. Sorry. So this year, 1,000 crores. Last year, 700 crores. A lot of cash, extremely cash rich company. Then you see current assets. These are assets which can be converted into cash in 1 year. Represents the financial short-term financial health of a company. In calculating that important, you can see total current assets. We come around. It's around 2,220 2,232 crores is the current assets. We move down in the current liabilities. These are liabilities it has to pay back within 1 year. And you see current liabilities coming around to 1,161 crores. So current assets 2,200, current liabilities 1,161 crores. Divide current assets by current liabilities, you get a current ratio. And it's more than two. It can be a good thing, not necessarily a bad thing. And yeah, it is good. More than two, it's nice. You can see the company in terms of non-current liabilities, long-term borrowings compared to its assets and all that are kind of negligible, not really that big. So that was the balance sheet. A lot of cash, 1,000 crores of cash. And finally, I think we can show one more thing. Under the profit and loss, here, here, pay attention to interest. pay attention to operating profit and then this interest. Okay, interest will be the third row below operating profit. So 129 crores of operating profit and 18 crores of interest payments in 2015. To divide operating profit by interest, calculator, 129 divided by 18, 7.16%, 7.16 times. This is the interest coverage ratio. If it's less than 1, it can be concerning. More than 1, nice. And 7 is very, very healthy. Let's move to 2020. So we have 287 crores operating profit, 25 crores of interest. Third row, 25 crores equals to 11 times interest coverage ratio. Okay. We move again, 2025. We got 470 crores of operating profit divided by 35 crores of interest. Uh, 13 times interest coverage ratio. Interest is basically negligible. I think debt itself is not an issue for the company, I think, but doesn't matter what I think. Very cash rich, very strong position, has shown good growth in cash flows as well as um, profits and revenues and all that. And finally, new segments, exciting segments. The EV charging one is interesting, and the DC charges market, 1 to 4 billion market potential. Yeah, that's a good thing. Finally, I can show this. I think so. This is Castrol Oil. Castrol Oil. I think this is the number one company. And in the profit and loss in screener, you can see the compounded sales growth has only been 5% over the last 10 years, 7% compared to Gulf Oils. This is Gulf Oils, 14%. So I guess they are closing the gap. This leader, Castrol Oil, does have way better operating margins. This is Castrol Oil. Hold up, let me just bring it up. Castrol Oil, okay? The profit and loss, against profit and loss, the revenues were around 5,365 crores. Okay, operating profit margins 24%. Leader in operating profit margins, really a leader. 24%, but 5,300 crores in revenue compared to around 3,500 crores of revenue for Gulf Oil and operating profit margin of only 13%. So that was Gulf Oil Limited's. They pay a lot of dividends, I guess, and a great growth in dividends. So yeah, that's it. Hope you enjoyed.